for Financial Link, and is quite well written and very formalized. I'd like to invite Aniket Ulal on stage. So Aniket is the founder of First Trader, a provider of exchange-traded funds, and has graduated from IIM Ahmedabad and Northwest Kellogg School. So, welcome. With that, we hand it off to the capable hands of Mr. Gaurav.
Thank you. Thank you. Can you hear me?
Loud and clear.
All right. So the topic for today is the next 3 years, and we evidently have a very articulate and very opinionated panel. So the right thing to do would be to actually give everyone time to tell us their projection on what's going to happen in the next 3 years. We have perspectives on things we really care for, things like finance, things like education, things like health and finance, and health and tech, and each of those combinations. That would be the right thing to do. But I grew up in India on Bollywood fare. I like masala in every damn thing. I like masala in my movies. I like masala in my chai. And so why the heck should we not get masala in our panel? So we're going to twist things around a little. We will talk about the next 3 years, but evidently predicting the future is an exercise filled with danger. Predicting the past, looking at the past, we always see it as a straight line. Everything is clear to understand, and evidently so. But projecting out in the future, it's not easy to see what's going to happen. So we're really glad to have this panel here because we can see from experts and practitioners their perspective of what's happening in health, in finance, in personal finance, in tech, in investing, in higher ed and marketing. There are unique perspectives out here. But here's the masala. The masala is this. We can make predictions, but those predictions are subject to surprises. And those surprises are things like the subprime crisis, things like Donald Trump rising, things like oil prices declining. Stuff happens. And the thing is, none of us saw those coming 3 years back, but those have happened. Well, not the subprime crisis. But we opened the year with the stock market declining, and then of course in retrospect you kind of understand why it happened, what's going on. But really, who saw it coming? So what we're going to do today is really ask the panel questions that are not your, tell me the future questions. They're going to be twisting things around a little. Tell us the future and tell us what it's sensitive to. Tell us what you see and what you see not happening. And so we're going to go back and forth in time. This will be confusing. I trust that you will not be able to build a grand theory of everything by the end of this panel. We're pretty sure of that. But you will get interesting perspectives. We'll do 3 waves. The first is getting a straight cut, asking the panel to give us their perspective on what's going to happen in the next 3 years, or what's not going to happen in the last 3 years, or what didn't happen in the last 3 years, depending on what their perspective is. That's the first round. Next round, I'm going to ask them questions. And at this time, if you have questions, I'd encourage you to write them down, and we'll have volunteers running and catching those questions. And the third pass we do will be with your questions. So that's a total of 90 minutes. This promises to be power-packed. This is a great panel. Everyone I've spoken with is super intelligent, super articulate, and they have the most interesting points of view that you can find in one panel in one place at one time. So I'm looking forward to this, and I don't know how it will turn out, but I know it's going to be huge. All right. With that said, I'm going to start with, let's see. I'm going to start with you, Jonathan. So Jonathan, would you, in the next 3 years, what are the trends in personal investing that are interesting to watch? Anything on?
Nope.
What do we have in the hand?
Yeah, I'll give you the answer.
Right, thank you. So our firm, Bellator Financial, we work with financial advisors. So we're focused on the advice channel, and so this is everybody from stockbrokers to financial advisors, anyone that you go to seeking help on your investments, whether it's an IRA or 401k or some perspective. So that's the area of focus that I'm going to be speaking on, and what we see happening in the next 3 years. And I'm going to take it from a play by Arthur Miller, The Death of the Salesman. And so The Death of the Salesman is I think where this industry is going on the financial advice side. So you might not know it, but right now there's clear lines between regulatory bodies. One's called FINRA, and one's called the SEC, and everybody is calling themselves an advisor. But there's a big difference between one side versus the other. If you're selling products and earning a commission, right, the way that you're paid is the easiest way to tell the difference between these two groups. If you're paid a commission, you're essentially a salesperson of the product that you're representing. So if you come to me and I'm your advisor and I say, hey, here's a mutual fund I'm going to sell to you, or here's a real estate investment trust that I'm going to recommend to you. If I get a commission, I'm held to what's called a suitability standard. The suitability standard means I only need to make sure that it's suitable for your age and your risk tolerance. I don't need to disclose anything. I don't need to do much else than just make sure that it's suitable for you. If you've got a problem with that recommendation, you try to sue me, you can't, because we have a contract that says that we go to arbitration, we go to mandatory arbitration, and we'll settle something out there. Contrast that to the other side, where if you're a financial advisor that actually gets paid a fee, right? So here I'm not getting paid a commission, I'm getting paid a fee for ongoing and continuous advice. And on this side, where I'm getting charged a fee, I can talk to you about anything. I can talk to you about education. I can talk to you about retirement. I can talk to you about all sorts of planning. On the suitability side, I can't. My recommendations can only be limited to the type of product that I'm recommending to you, or they call it incidental advice that might come forth. So why is that important? Well, it's important because a lot of people that lost their money during the Great Recession and the crisis that happened in 2008 and 2009 were really frustrated with the type of advice that they were given. And they wanted to point their finger at somebody, and so eventually it got into the Dodd-Frank law in 2010 through basically mandating the SEC to go out and create what's called a uniform standard of care. They wanted to take this fiduciary standard and apply it across the board, or even make it stricter to everyone. The US was not alone with this. Believe it or not, in the United Kingdom, commissions have been banned. In Australia, commissions have been banned already. So this has all happened in the last 4 years. In the United States, commissions are such, the products are so diverse and so widespread that the lobbyist efforts have basically been able to hold it back. And the SEC hasn't been able to spend their time to try to get this set. But the Department of Labor recently came out with a rule that actually was just earlier this month, requiring financial advisors to be held to this standard. And what it's going to do is they're still allowed to use commission, but now they're going to actually be held to that legal standard of being a fiduciary. Another way to think about a fiduciary and the people that you interact with, that you assume are fiduciaries, are doctors and lawyers. Your stockbroker is not. Somebody that sells you products is not a fiduciary. Right? So what the SEC is trying to do, and what Dodd-Frank's trying to do, is try to get everybody on that same playing field where you're really perceived from this advice standpoint. So I think there's going to be a real big dislocation in this space, in the financial advice space. And you pair that with two trends. One is that 1/3 of the advisors that are out there right now are going to be retired within the next 8 years. So you've got a big gap coming from the actual people that are in this space. A lot of them are going to probably advance that retirement because they're not going to want to deal with the changes to their business. And then the other is the emergence of what are called robo-advisors. So if you've heard of a robo-advisor before, basically it's a way to get money management advice or investment advice through your computer. And so instead of going and meeting with a professional or talking to somebody, there's software out there now. The biggest names are Vanguard and Schwab, names that are kind of on the merchant side, or Wealthfront and Betterment. These are established firms now. Some of them are VC backed, looking for someone to acquire them or to go public. We'll see how that goes. But right now, the industry in the robo space is about 300 million, and they anticipate it growing into, 300 billion. They anticipate it growing into about 2 trillion by 2020. So that's a 60% 8% annual growth rate they're anticipating for that space. So a lot of money is going to be flowing into these robos, and they anticipate half of it's coming from just people with cash that they haven't put with a professional because they're afraid to go talk to somebody about, you know, a traditionally taboo topic, or money coming from professionals that are managing it right now. So the robos are shaking up the space because they're bringing down the prices of advice. But we think it's a good thing because it's actually going to change what happens to these advisors that are out there right now. They're going to have to change from, you know, providing just a very basic investment recommendation to providing comprehensive advice, where we think that's really where the value is. You know, people compare the robo trends that are coming. You know, they're looking for, you know, is it going to wipe out all the advisors? You know, is it going to do to the travel agency, or the travel industry, what Expedia has done to all those travel agents? You know, we don't think so. It's probably going to be more like what the accounting profession has experienced, right? You've still got a lot of people that have been doing it themselves. Now they can do it with online tools, and a lot of them are free. And when you have really complex financial matters, you're most likely going to go and seek an individual. But for some of the easy stuff, I'll call it the layups, you know, you just want to set some money aside, you know, put it for retirement or an education fund. You don't feel like you need to go and talk to someone, that's where the robos come in. And I think they're going to really be an emerging technology and an industry player over the next 3 years.
Thanks, Jonathan. Thanks, Jonathan. Next up, I want to ask you, Archana, a few questions, but I'll ask you the reverse question, which is, there's a lot of talk about health tech, and there's a lot of talk about how health tech is, you know, coming in, and it's a mega trend. In the next 3 years, which trends in health tech are unlikely to find mass adoption?
So you add the masala in my question.
Yeah,
There you go.
it's a great question.
Okay.
Okay.
Okay, that's great. So spoiler alert, we are living in a digital health bubble. So if you haven't figured out yet, get out soon, or get to a company that would make sense. So I see a couple people who are in digital health in the party here, so let's address that. What's going to die or morph in the next 3 years? So we need to look at that with 3 curves. That's what I talk. In my job, I have to say a lot of no's because we keep on getting pinged from this new tech company around the block and how this will improve the population that I'm managing of 270,000 people. So a lot of no's and very little yes. So we need to know all of the curves that are out there that we need to look at. One is the Gartner curve of hype. And that's mostly this is the IM crowd, you probably know that. The second curve is what we have in healthcare industry, is curve of maturity. So you go from infancy to adolescence, and then you become an adult company, which knows the industry and learns as it goes along. And the third is the policies that layer up on the top of it. So the policies that the government sends our way, the politics sends our way, and a classic example is Obamacare. And I'm dreading what happens after the presidential election, but more to come on that. So after putting all these 3 layers in perspective, I'll give you the 3 Ps as 3 facets of healthcare industry. And I will give you maybe 1 example or 2, and then I have many more, so maybe we can talk after this conversation. So the first P is the patient or the consumer, or we call them member too. So these are all 3 names of the same exact caliber of people, and which are you and me, essentially. In that space, the patient monitoring devices are one in which a lot of revolution is happening and yet to come, and a lot of death is going to happen there of devices. And one is your wrist-based wearables. Your wrist is your highest, the premium real estate on your body, if you think about it. You put a watch there, now you got the Fitbit, Garmin's, and then now there's a 3rd generation called the Apple Watch or Samsung Watch. And more to come of that, but the first generation of your wrist wearables are going to go. And these are your standalone that don't have any value proposition for you, which is what they don't change health behavior. And the second one is these health apps. We know that 75% of the health apps will not be used in 3 weeks from now. So have any one of you downloaded a health app recently? There you go. How many of you are still using it? Good for you. Are you in within 3 weeks time frame? So the only reason why people actually continue using the health apps, if it was recommended by a trusted source. And that's what the stickiness of health behavior change is. So that's the second space in the patient front. And the third one is patient monitoring. So that's the space that I come into, the clinical monitoring, so the blood pressure monitors and then the glucose monitors. They are also standalone. They don't give you what to do. So there's a lot of innovation that's happening, and look out for Livongo, for example. It's a glucose checking machine they merged with your smartphone. So now in real time, if somebody gets a 300 of glucose read, it goes directly to a health coach, and they call the patient back, and they make a change, an actionable change that impacts their health outcome. So look out for those mature companies that are learning from this market where these standalone technologies are going away. The second P is the provider, or the physician, or me. This is the space in which the standalone EMRs are here to die. And there are multiple reasons why. One is there is something called billing. And we are all hurting from billing. And there are two components in billing. One is the ICD-9 code, which is the diagnostic code. And the second one is a procedure code, or CPT code. Forget the procedure. Let's talk about the diagnosis code. So just recently, there was a major shift from ICD-9 to ICD-10 that happened. And very few electronic health record companies were prepared for that change. And so all of these standalone are going to die. So look out for those. The ones that will survive this onslaught are the ones that are integrated with patients' data that's coming through wearables and monitoring devices, integrated to your electronic health record that is integrated to the health coach or disease management. These are the companies to pay attention to, and they will continue to live. The third space is the payer space, and that's where I kind of sit in that space, being in corporate health. The payers come in two forms. One could be your employer, which is the self-funded, and the other one is insurance industry, which is the ones that you hate. So essentially, your middlemen, and that's the space that has traditionally given recommendations on claims-based or looking in the rearview mirror, and that's going to die. So the technologies that are selling you your risk of population health solutions are going to die. The ones that are actually doing predictive modeling, for example, IBM just had a recent acquisition of Truven, because they are adding artificial intelligence, machine learning into that space. They are going to live. So that's our future 3 years trend. So ones that will survive and ones they will not survive.
Thank you. That's brilliant. That just blew my mind. So Ram, with you, we're going to flip back in time, and I'll ask you this question: what are the trends in higher ed that people that have surprised you in the last 3 years, in the sense that people saw them coming and they didn't come?
Cool. So I'm going to get off this high horse. Sorry, it's kind of hard to sit there, and these lights are killing me. So I'm going to walk here. Sorry. So thanks, Gaurav. When Gaurav reached out and talked about this panel with me, I instantly, I'm at Google, right? So I instantly Googled trends in higher ed in 3 years and got a whole list of trends. So that was really easy. And then I thought back a little bit and saw, all of you are going to be able to Google it, right? So there's no point talking about that. So I'm going to talk about my personal experience and about, I moved into higher ed university about 4 years ago. And I moved into the industry from advertising. So, I kind of tell stories. So I'm going to tell you stories about my experience at Berkeley and how it ties back to what I had read about trends before I came in, right? So one of the key reasons why I joined Berkeley was because the whole concept of brand building in the higher ed space was becoming more and more important, right? So people were saying it's more important to market, it's more competitive to get the right students and so on. So when I came in, we did a whole brand platform at Berkeley, and then I started going to conferences and talking about it. And what I found was that a lot of schools started reaching out to us and saying, how do you do this? How have you guys done this? We had folks who came from Oxford, someone who came from Australia. And again, everyone was trying to figure out, how do you do branding in higher ed? It's really complicated because it's very distributed. And then, about a year and a half, or I guess 2 years ago, the University of California system, which is what Berkeley is part of, the marketing team there looked at changing the logo. And I don't know if you must have read about it at some point, but there was a huge outcry from alumni. And they had to actually turn back the new logo design that they had created because of the outcry. So that was, marketing going forward, and then suddenly it had to get pulled back because the stakeholders were really complicated, and that was hard to know when you were predicting. And then just a few months ago, the University of Oregon had a $15 million marketing campaign planned over 5 years, and there was a very high-profile thing where it was pulled right at the start because the faculty were not on board. A lot of the faculty said that that's a waste of money, and at Berkeley, as I work in marketing across all the units, a lot of my job is trying to reach out to faculty and talk about our initiatives and make sure that they're true and they tie in with the way the faculty look at things. So again, stakeholders being so different, it's really hard to predict where branding or marketing could have gone in higher ed. So that was one interesting insight for me coming in from advertising. The other thing that was interesting was was the world of online education. Obviously that's a huge area. It was huge 3-4 years ago. It still is huge now. When I came in, again, a lot of the people on campus, we were looking at setting up units that were going to explore best practice in online education. We had set up a unit that was actually going to go out and start getting faculty interested in the whole space and training them and trying to get everybody on board to do these online courses. But over the years, as we've found that it is a kind of education for all, but a lot of the people who are taking those courses are actually people who are already educated and are taking those courses to just try and improve their knowledge in a particular area. A lot of the courses being done on edX are being taken, for example, by teachers, middle school teachers who want to, again, improve their knowledge and learn about what the latest thing is. So as a result, what happened was that the unit on campus that's actually looking at trying to get more and more courses online has started becoming more strategic about it, and now they're no longer going and trying to market that service across all units. They're actually looking at what can you do online which can help, again, increase the scale of our influence, and again, from a financial point of view as well. So they've had success with a couple of online master's courses. Masters in data science was one. There's a master's in public health, I think, where again, it's people who are working in the industry who want to do this part-time. And they've looked at this mix of obviously doing it online, but also having something where you come to campus or you meet for a class somewhere, once or twice a week. So the thing is, I think it's not been purely online, and the whole thing of universities kind of dying thanks to the online world hasn't happened. I don't think it will, but we can talk more about that later. So these are the two interesting kind of areas that I kind of explored over the last 3 years, which didn't really come true.
Thank you, Ram.
That's it from me.
Thank you, Ram. Quick quiz. What is the most common last name in this room?
Sivya.
Vibhor is probably a relative. We haven't figured that the family tree out. Vibhor, you're a VC, and I wanted to ask you this question: what are over the last year, there's been a lot of fascination about unicorns. From the time the article came out a year ago, there were someone counted 229 unicorns. What are the trends in the news about these unicorns that are likely to be proven wrong in the next 3 years?
Sure. Yeah, happy to address that. Let me just maybe just spend 30 seconds on Intel Capital, because a lot of people might not know what the organization does. So we are the corporate venture arm of Intel. Intel Capital's been investing since '91, so 20 plus years of track record of investing. And in that time frame, Pinnacle Capital has deployed about $13 billion in startups, invested in over 1,000 companies, has had over 500 liquidity events in the time frame, both M&A and IPO, and really invests in all areas of tech as well as all stages of tech. So from cloud, big data, mobility, Internet of Things, AR, VR, autonomous cars, robotics, so pretty digital health, personal finance, some aspects of personal finance. So pretty broad swath of things that Pinnacle Capital invest in. I personally invest in enterprise software, so that's the area that I focus in on. So with that, maybe I'll just give some facts and also just maybe get a show of hands in the room. So about $70 billion was invested in the VC asset class last year, which was 2x what was invested in the same asset class 2 years ago, right? So you can see that there was definitely an increase in investor sentiment in deploying capital in the VC assets class. That number has come down dramatically. It started coming down, so Q4 15 was much lower than where Q1, Q2, Q3 were last year, and Q1 16 has been relatively low as well at a $15 billion per quarter run rate, right? So if it continues at that pace, you know, the smart IM crowd here, you know, you're already seeing a decline year over year in the VC investment class. So just by a show of hands, if we were projecting in 2018, and let's say about $60 billion was invested in venture this year, how many people think in 2018 or 2019 more is invested in venture and then relatively speaking less? So how many people think that in 2019 more than $60 billion will be invested in the venture asset class? By a show of hands. Okay, so that's the optimistic crowd, world is all rosy. And how many people conversely think, and some people can be neutral, so how many people conversely think less will be invested in the venture asset class? Okay, so this is the short crowd. Okay, good. I think there were more people that think more will be invested than less. So I think that's where the crowd's coming out of. And then same sort of question, how many people think there'll be more unicorns than I think Gaurav just said 200 something unicorns. And unicorns, you know, companies with more than $1 billion in valuation, right? How many people think here there'll be more unicorns in 2019? Okay, so very handful of people. How many people think there'll be less? Many more. Okay, all right. Wish there was a way to short private stocks, right? People are still trying to figure that out. I mean, you can be a VC and really do down rounds, which is what we are doing right now. And that's one way to short those stocks. Okay, and then, you know, and a phenomena that was why the more got invested last year was really the crossover funds, right? So sort of the people that Jonathan works with, you know, the Fidelities, T. Rowe Prices, BlackRock, they all came in the venture asset class, right? Flying in from New York, paying a lot of, you know, investing hundreds of millions of dollars in late stage financing rounds. How many people think that the large crossover funds will pull out of the venture asset class and go back to public market investing in 2019? So, okay, and how many people think that they'll actually double down on their venture asset class and keep investing more? Okay, all right, your retirement assets are safe, so I think that's the right strategy. So I think, you know, I think the crowd sentiment generally is that more gets invested in the venture asset class, there are less unicorns, and then the, you know, the crossover investors start to dial back their investing. I actually subscribe to that view, except for the first part. I think the venture, there is a healthy pace of investing in this asset class, and you know, this is not, you know, private equity is about a $250 to $300 billion asset class. Obviously, public markets are $15 trillion invested in the public markets. I think there is a pace and cadence to investing in the venture asset class because these tend to be highly risky investments that are, by their very nature, very risky bets in the future. And what ends up happening is when you do have these sorts of peaks, and we had the same peak in 2000 as well, when NASDAQ was booming and there were predictions of Dow 36,000 and whatnot. And the industry went through a massive restructuring after 2000. A lot of venture funds went out of business. A lot of startups obviously could not raise money because their investors themselves did not have money from their limited partners. And something very similar happened in 2013, 14, 15. You had a fairly robust M&A IPO climate. A lot of people were making a lot of money. The headline was 15 people at WhatsApp and at a $19 billion exit. Oculus had a $2 billion exit. Public markets were very kind to the companies that were going out. Very little profitability, still trading at 10, 15, 20 times revenue. And that just started this vicious cycle of, frankly, greed, which is good and grease for the capitalist economy, but has to get reined in. And a lot of people thought of it as easy money, right? You come into the asset class, put in $500 million, and you can double your money in a year. It takes you 5 years to double your money in the public markets. So why not, right? And that, I think, phenomena you can already see cooling off, and people deploying their capital, more astutely than it was done in 2015. So I do think that a lot of these unicorns will see down rounds, will frankly go out of business. So you've had Homejoy that has shut down, Shuttle, and they were not necessarily all unicorns, but some of them had raised up a lot of capital, and then when they came to the market to raise more money, the unit economics just did not work for the VCs to continue funding those investments. So I think the number of unicorns will go down, number of crossover investors will go down as well, and I think the VC asset class, will it stay at 60 billion or will it go down to 40 to 50 billion dollars is up for debate, but I think this is a healthy level for this to be a long-term innovation engine to drive growth in the future.
Thanks, Vibhor. Next up, from the time when I first heard the term, I said, what WTF, right? But ETFs have become increasingly popular, and all of us, we may have, I definitely heard of it, we may have put our money into it. And the question that I have for you, Aniket, is, in the next 3 years, what's likely to happen that will make people care even more about ETFs?
So I think as I look at capital markets and investing generally, and I'm overlapping a little bit with Jonathan here, when we talk about change, it's sexy to talk about revolutionary change, right? But I think that, at least my view is in capital markets and investing, we're going to see more evolutionary change rather than revolutionary change. And I think part of the reason is because there are certain underpinnings of the way our capital markets work, where there are very strong, to use some jargon, network effects, right? So for example, the way our currency system works, the way our trading infrastructure works, right? These things are incredibly hard to displace overnight. And so I think finance, trading, and so on is an industry that's ripe for disruption, but it's also extremely hard to execute on, right? So for example, do I see Bitcoin replacing the way we use currencies today? In the next 3 years, I don't see it, right? I think in that sense, I think it's going to be more evolutionary. And I do think, but I think those evolutionary changes are going to be significant and are going to really impact the way investors invest today. And I think, in my view, at least, admittedly I'm biased because I started to run a firm that provides ETF data. But I think that ETFs are fundamentally changing a lot of what's available to investors today in very meaningful ways. So I think a couple of things. One is, one thing that's really changing is blurring the lines between what we saw as active investing and passive investing, right? So historically, we've always thought of, active investing to us has been a fund manager who's deciding which stocks to pick, growth stocks, value stocks, what your strategy is, put it in a mutual fund, somebody invests in it, right? And passive investing was you buy a low-cost Vanguard index fund. And those lines have really gotten, and this is not a new thing, so I think it's evolution. I mean, ETFs have been around for over 20 years, right? But it's really now that we're starting to see the effects of it take hold. And so I think that blurring of the lines between what we thought of as traditional active investing and traditional passive investing really blurred. So for example, you might have products now, and we have a lot already, where you're investing in an ETF, it tracks an index, but that index already has a bunch of rules built into it, right? So that index is deciding how to hold overall stocks, or growth stocks, right? Or momentum stocks, and so on. Now, is that passive investing? In a sense, yes, because you're not paying an active manager to select the stocks, right? It tracks an index. But is it truly passive investing? Not really, because you've got an inbuilt view or a strategy built into the index. So I think that's one fundamental change that ETF is bringing about, which is this blurring of the lines there. And I think the nature of active management is going to become more deciding which asset classes to be in, deciding which strategies to be in, and maybe using some of these fundamental building blocks to build cross-asset active portfolios. So I think that's one. I think the second is, and it's related, is the democratization of investing. Right? And I think it's a pretty fundamental shift. I mean, 10 years ago, 15 years ago, we had very clear distinctions between what is available to a regular retail investor versus what is available to, a large institution, right? So, for example, we talk about David Swenson's model at Yale, right, where he invested in commodities and so on, and that wasn't accessible to the average person, right? You either had to be an accredited high net worth individual and so on. Sorry, can you hear me? So you had to. So in other words, what is available to the average investor was quite different from what is available to a large institution or a high net worth individual. And those barriers have really come down now. And I think ETFs have played an important role in making available asset classes and strategies that all of us can access that weren't available. I mean, for example, you can invest now in emerging market debt, you can invest in gold, you can invest in commodities that hold futures contracts, right? So you can invest in fairly sophisticated rules-based strategies. So I think it's really this two things. Like I said, it's going to be evolutionary change, and that evolutionary change is going to blur the lines between active and passive, and also make available products to us that weren't available, even 5-10 years ago.
Now we're going to start the Q&A. So if you have questions, please write them down, send them up. We have volunteers who can collect your questions from you and answer that. So let me kick this off right with you, Aniket and Jonathan. What asset classes should people learn about when thinking about ETFs for their own investment?
I think to me, there's two aspects. One is asset classes, the other is strategies, right? So I think the main thing, and this ties into what I mentioned earlier, is I think the ability to work across asset classes is probably the most important change. So in other words, earlier it was all about being into equities or just equities and bonds. I think now there are a lot more options, right? And obviously that asset allocation is going to change based on where you are in terms of your risk return profile and age and demographics and all that. So everyone needs their own individual kind of plan. But I think you now have much more availability in terms of the asset classes you can be in. I think we also have much more choice in terms of the strategies we can be in, right? So for example, now we're at the end of a pretty long bull market. Do we think this is going to continue? I might want to continue being in stocks, right? But at the same time, maybe mitigate my downside. So maybe I might look at a low volatility strategy, right? So I think it's this ability to access these kinds of strategies are much more accessible now than earlier.
Yeah, and I'll echo on the comments on what's important, because we go and talk about a variety of asset classes and sub-asset classes, but I'll wear my planning hat and start with that. You always start with your time horizon when it comes to investing, and then as you work down and figure out okay, what should my overall asset allocation be, then you can start entertaining some of these different strategies. Because you don't want to get too cute with all your investments, because what you might find is that everything that you're holding is really correlated, or it was what was hot. So you referenced low volatility securities. So low volatility securities have been pretty popular over the last few years. The problem is, when we look at those ETFs and those strategies, is that their PE ratios are higher than the marketplace. They're higher than what the S&P is. Some of them are in the 20s when the S&P is at 16, right? So you got to be careful, and that's the benefit and the curse that you get with ETFs, right? They're easy to get to. You can trade in and out of them the same day, same 1 minute in and out because of the liquidity. But the marketers and the providers, and I think there's over 1,500 ETFs now. They just keep dumping product. And so you got to be careful. You got to do your homework when you're looking at these different asset classes, because not all of them. Some of them are just being marketed to you. right? They're trying to take advantage of a trend and they want you to put your money into it because of a sexy name. So, I think that's, again, two things. Start with your time horizon. Make sure that what you're getting into isn't just a bet, right? Because we find a lot of investors end up just gambling with their money when they think it's really investing. And then the other is to do your homework when you look at these products because there's so many of them now.
So there's a follow-up question to that, which is, should retail investors invest in equity asset class as opposed to, mutual funds or ETFs? Directly into stock versus mutual funds or ETFs?
Depends. So what you might want to try is a combination if you're looking to start. If you start going into individual stocks, you better, I'm going to echo it on the ETFs, you better be doing your homework, right? So you better look at how the company's financed, how it's generating its revenue, what its future growth prospects look like. Because if you just hear something and say, oh, you know what, that sounds like a really good investment idea. Oh, GoPro, like, wow, I love that product. It seems like it's going to do really well. The stock already took off. It's down 50% from its IPO. And that's after it almost went up 50%, right? So you got to be careful. You got to pick and choose, and that's where I think doing your homework comes in. And that's where I think, my comment is combine it. And if you're going to make a choice either or, you're probably going to go. I think it's probably wiser to go with something that's more diversified. Pick a mutual fund or an ETF, right? I mean, you're getting the same underlying. It's just you need to understand how those stocks are being selected.
Just adding one quick thought to that, which is, I think there's a distinction between product structures and asset classes. So in other words, ETFs and mutual funds, obviously there's a product structure difference, right? And then each of those can give you access to different asset classes, whether it's equities or bonds and so on. So there's probably a bunch of different decisions there. I agree with Jonathan that you've got to be careful with whether it's ETFs or mutual funds or stocks, you have to do your research. But I do think that for the average investor, something that's diversified and low cost is obviously a lot better generally than something that's a concentrated bet, right? You have less time to invest to research individual stocks.
Thanks. Archana, I have a question for you. So in your talk, you talked about Obamacare and you let that pass. So do you expect changes to happen because of the election and if an adverse government comes in? So two-part question. One is, do you see a pullback of Obamacare? And two, do you see an impact on health tech companies in general because of a possible change in government?
So I'm going to throw this question back to the audience. How many of you think that Democrats will come into the White House? Okay, this is California. How many of you think that it's going to be Sanders? Nobody knows. Okay, so here's the thing. That's a wild bet, and in the swing states. I mean, I truly think that if the Republicans come, they cannot take away what has been given to the people. But there is going to be a different version of it, more sold out to the lobbies. I mean, that is something that we also saw. The current version of Obamacare is sold out to the insurance lobbies. And that is not my personal opinion, that's the opinion of the healthcare industry. It is not a perfect version, but it is good that it's out there, so at least something different or an iteration of it would happen. If a Democrat comes, which is also a very divided field if you look at it, if the Clinton folks come, and I call them together because you got 2 for 1 in a way, you will get a continuation of somewhat of a similar policy in the direction that Obama was going. And then if you get Sanders, you get Norwegian country. So that's pretty much the two directions we're going. Having said that, it's also very much dependent on how well either of these parties are able to get the Senate and the Congress popularity. So it's all up in the air, and it's your guess is almost like what my guess is. Having said that, the Obamacare, the way we look at it, is here to stay in some form or shape. It is hard for that to be undone by any government that comes in the White House.
Thank you. So Ram, I have a question for you. So there's increasing dependence on China and Chinese students into the U.S. university system.
Yeah.
And if the Chinese economy continues to not do well, and for some reason, thanks, and the number of Chinese students coming in for studies, full-paying students coming in for studies, if that drops, what kind of impact do you anticipate that will have on U.S. universities?
Right, we'll have to shut down, I think. Okay, sorry. So I guess, yeah, we have obviously huge numbers of Chinese students that come in. Again, they're pretty distributed, so not all universities get them. They go to certain universities that are either marketing directly to them, Arizona State or Northeastern, and they go to these big brand names, right? So, for example, Berkeley is a huge brand name in China, and obviously we have a large number of students that come in. So as that goes down, yeah, there's definitely going to be an impact in terms of, I guess, the full-paying students that are coming in. The impact of that is not just on those students, but about 1/3 of every full-paying student is what's called return to aid, which is the aid that goes to California residents and a lot of other students who need that money. So there would be a reduction in the amount of money that we have for financial aid. Even if we look at the kind of departments that typically the students from China go to, a lot more in electrical engineering, computer science, kind of areas that they find very useful in their work environment when they go back, not so much kind of liberal arts. So certain departments would get affected for sure, but one would have to adjust. I mean, for example, we have 100,000 applications for 8,000 seats. So I think universities, the stronger brands will definitely survive that. The ones who focus too much on that market will definitely kind of suffer. I don't think it's going to happen though.
No. So Vibhor, I have a question for you. What will it take for tech IPOs to come back in full force? So not whether they will come back or not, but what will it take for that to happen?
Yeah, I think pricing, like GoPro pricing, right? Which is the private market pricing to be more rational, and the unit economics to be much better than what they have been in the past, right? So effectively in the last 3 years, any company that has gone public, I think there's like a handful, there's like 3 or 4 that have traded above their IPO price. Most everybody has traded below their IPO price, and it's a very unusual dynamic if you think about it, because a private company stock is inherently more risky to own, because it's not a freely traded security. So it has to be cheaper than the equivalent security in the public market, and it was flipped the other way around, where investors were paying more for a private stock than public market investors were willing to pay for the same security. So and that phenomena, which is rational pricing, I think has started to come back to the private markets, because people are looking at what's happening in the public market. So Salesforce, LinkedIn, Amazon has come back. Google dropped a little recently, but people just looked at what was happening with these high-flying tech stocks, and how public market investors were getting much more rational about their valuation, and private investors started to say, well, if we start applying liquidity discounts to what's happening in the public market, there is no way that this company is worth this much in the private market, and VCs are starting to have very, very hard conversations with their existing companies as well as the new entrepreneurs. So once that pricing rationality comes in the private market, then the public market investors know when a company is coming to the public market, there is upside for them, right? They're not sitting on a company that will be down 50% like GoPro was, or will be down Gaslight Health, which Dr. Dubey might know, which went down by about 80% when they went public, from a $1.2 billion to $200 million market cap. So, many such examples of speculative companies coming to the public markets. So I think it has to be pricing rationality, and then which translates into upside, and the other side is unit economics. public market investors had become very forgiving of burn rates. So you were coming to market burning $10, $20 million a month, right? And there's a class action suit against Hortonworks where apparently they disclosed something, and that's what the litigants are claiming, that the company did not fully disclose the burn profile and did not fully disclose that they were going to do a secondary offering pretty quickly after going public, which obviously dilutes the investors that had bought public stock. So all those factors will start to play in the unit economics as well as the valuation.
Just to follow up on that, and this is to all the finance people, this is a stock tip question, so feel free to. So when tech IPOs come in, should we buy them for the pop or should we buy them to hold because we truly believe that this is a great company and will do well?
I'll pass it on.
So it's going to vary on the stock, right? I mean, it's as you were speaking, I was thinking of investing, right? Investing is a relative thing. There's always trade-offs, right? You have money. You have the choice of putting it in cash, leaving it there, right, and hoping that inflation doesn't eat it away over time. You can put it in bonds. Or you can put it in stocks or maybe liquid investments as well. Terms like FANG were really popular last year, right? So for Facebook, Amazon, Netflix, and Google, that was really driving the market forward. You can throw in Nike and Salesforce and Priceline as some other companies that really were behind the market. And so, like I said, it's a relative world. So people, they can put their money in government bonds and get next to nothing. If you're a European investor, you have negative interest rates to deal with. The Japanese investor has negative interest rates to deal with. So where are you going to put your money, right? And I think that's where people, and I'll add in that, we're in a growth-starved world, right? Look at what's happening during earnings seasons right now. Revenues are just stalling, and companies are having a hard time growing that top line. They're doing a great job managing the bottom, but that top line growth is hard to find. So any company that's coming out and actually has a legitimate way to grow revenue, and they can do it for the continued future where it's not so a niche product or something, I think those are potentially good things that you might want to hold for a while, right? So it's going to vary depending on the product.
About Facebook. So it was going IPO, and this is coming not from a financial industry, but I just wanted to share the story. It was going IPO the next morning. I pestered my husband to put, buy order, because I love the company and it's the experience, and almost the same way the consumers spend into the public market, right? And of course, I heard a lot about that $40 stock for, I think, 3 months, and then he stopped complaining because that's what it is now. So I think the other thing is a validated, business model is a great place to invest in. Chipotle being the other one, but don't go eat there.
Okay, back to Ram. So Ram, you spent a lot of time in the agency world, right? And the world of marketing itself is changing. And in the world that I interface in as well, there's a lot of investment into marketing technology and the move to digital. Is that trend unassailable and unstoppable? The move towards digital and marketing becoming mostly digital and the dollars going to digital ad dollars more than anything else?
Yeah, I think so. I mean, I've seen budget shifts, again, when I was more in the advertising world, I've seen budget shifts for large corporations like Procter & Gamble going to 40%, maybe 50% even into digital markets in certain areas. But again, it was depending on which markets they were in, right? In our case, we were planning for a brand campaign of late, and we were putting maybe 30% of the funds into the digital market. A few years ago when I started out with some of my digital brands, it was an experiment with 5%, 10% and so on. Now it's a standard part of every media plan where X% just goes to the digital market space. So yeah, for sure, I think that's going to stay for all kinds of industries. And for example, for Berkeley, we do a lot of marketing for our business programs online. And again, almost the entire funds are going towards buying Google AdWords or doing display ads, partnering with companies like Facebook. and LinkedIn to kind of do very targeted advertising. Because the kinds of data that's coming in from those companies about consumers is really useful, and it helps us stretch our money by being very targeted about the kind of people we go after. So, yeah, sure.
I have a question, Rick. Why are you marketing? You have so many people applying.
That's a great question.
Why
Why is Berkeley marketing? Oh, yeah, that's a good question.
Shared the number of applicants versus the number of
Yeah. So Berkeley, it's complicated, right, as it always is. So there's the undergraduate program, which has about 100,000 applications that come in for the 8,000 seats. But a lot of the schools, for example, the business school has targeted EMBA programs as well as just MBA courses that they kind of reach out to people. And those are pretty competitive. So, you have the Haas Business School that's kind of competing against, Harvard and Wharton and so on. So in those areas, they do need to market themselves pretty strongly. Yeah.
And no offense, Cal, I teach at Stanford, so, and we do market, and it's not just marketing for the students or the e-students, but actually marketing for the faculties and people who teach there, and marketing for investors and fundraising too. So there is a lot of different facets of marketing that we as universities have to go through to get funding.
All right, we're in the third half of the panel, and this is where audience questions will be used. As I look at the series of questions, my heart sinks because one, I did not buy 3M stock when I should have, and two, you guys should be doctors. Three, yeah, and the third thing is I made a mistake, which is I did not declare that I'm going to ask you to ask your question directly, and so I didn't ask you to put your names on these. So I have your notes, and I don't know who wrote them. So I'm going to just randomly pick things and see what goes on. One question that came back, which was interesting, is in a 3-year prediction horizon, is it even possible to predict the future given the number of rapidly changing environments we're dealing with? This is an open question. Is it worth doing? I guess it's worth doing. Is it possible?
It's fun. Right? and you can't be proven wrong, for a while, because everyone's wrong. So
Yeah.
I think it's great. I mean, everyone does it, maybe intuitively for your own planning. You are doing it. Predictions are just like people standing up and trying to be more public about it. So yeah, I think it's cool.
Yeah.
Yeah. So our average holding period is about 8 years, and our typical venture holding period is about 10 years, right? That's the life of a typical venture capital fund. Intel Capital being an evergreen fund, we do have a little bit more flexibility, right? So if the company is doing well, but there is not a liquidity event in the 8 to 10 years, we can still hold on to the company and get a liquidity down the road. So by just that virtue of that fact, we do have to predict where things can be in the next 5 to 10 years. I mean, I'll take drones as an example, right? By the way, how many people here think that drones could become mainstream and there's a drone in every house and so
In
forth?
3 years?
In 3 to 5 years, yeah, in that time horizon. Okay, a fair number of people, and I tend to agree. Even though if you were taking a shorter term view, FAA is still heavily regulating where you can fly a drone, how high you can fly a drone, what kind of things a drone can do. There's still no anti-collision on those things, so it could actually be a safety hazard and that sort of thing. So by its very nature, in the venture side, you do have to think about 5 to 10 years.
So the healthcare industry does not iterate very fast, and part of it is rules and regulations, policies. But what I could say is the 3-year horizon is pretty predictable for the maturity curve that we talked about. So if things are in infancy and they are putting the right maturity elements in place, we can predict pretty well how well they do in 3 years from now. So we start looking at things in pipeline. For example, telehealth is a great example. So they work from cost perspective, from access to care perspective. So if they have the right ingredients, you can have a pretty good predictions in those industries. So, and it's not like a tech industry only. There is health tech both. So there's something that's underpinning all of these new changes and quick changes that are happening, but there are a lot of policies and procedures that hold it down and does have a 3-year prediction rate, pretty accurate.
when the iPad first came out, I thought it was a terrible idea, right? I mean, I was like, this is a product in search of a need. Now my kids have clearly proven that there's a need for an iPad. I mean, they spent 5 hours a day on it. So it's obviously hard to, technology is probably harder, I guess.
Yeah, since you have the mic, there's a lot of questions on fintech, and one big question is robo-advisory good or better than advice you might get from a financial advisor?
It's probably more consistent, but what we've seen, it's all going to be based on the firm that you partner with, what their algorithms are, and what they're really trying to offer. Right now, it's not that customizable. They're not doing things like asset location. They're probably trading a little too often with their rebalance policies. Some of them are advertising that we're going to go and harvest your gains as soon as they're there. There's a cost to that. It might not be a direct cost, but there's always a market cost, which we're never here on the ETF, so can explain more about. But I think it's definitely more consistent, right? So if you go to an individual, that individual is going to try to customize it. They might like a certain philosophy or like a certain approach, but you might not get that right away when you're talking with them. Whereas you go to a robo-advisor, it's going to be very clear what they're operating under, right? This is how they make the meal, and if you like this meal, sign up, because that's what you're going to get.
Okay. Ram, there's another question for you. This is it's an interesting question for all of us, which is there going to be, in the next 3 years, do you anticipate some sort of boom of mid-career execs going to higher ed for sort of retraining or retooling or sort of finding their next careers?
Yeah, I think so. I mean, I think it's, according to some statistics at some point, it's like 3 careers is average for people who are graduating from university now. So for sure, I mean, we are seeing, again, especially more in the business school, but also in certain other areas, a lot of people coming with 10, 15 years work experience and just totally transforming what they want to do. So yeah, for sure. I mean, I took, I went to IIT, IIM, and then decided to become a copywriter. So it was much shorter for me to find my 3rd career. But for a lot of people, yeah, I would see a huge boom that's coming for mid-career changes.
Great. Vibhor, lots of questions for you, but one question that's sort of repeated across is alternate sources of funding. Are you seeing those come up in the sort of investment community, in the venture investment community?
Yeah, no, absolutely, and I think there's a little bit of a revolt against the venture capitalists themselves, right, as sort of the gatekeepers of capital, because the notion being, if you're a very smart entrepreneur and you have really figured out what your product market fit is, why go through a gatekeeper, right? Who tends to be a VC who's projecting their own thoughts and their own idea and vision of what can work and what cannot work on that particular business, right? So Kickstarter started along those lines. People were trying to bring innovative hardware products to market and going to VCs, and VCs were cringing at unit economics, etc., and they said, well, we'll directly take it to consumers, show that there is advanced demand for those products, have them pay for it, and then once we have shipped our first set of products to people who really want to use them, then we'll go to VCs and use that for scaling. And we actually now rely on the Kickstarter demand gen statistics quite a bit as we look for business models to fund, because there is a very, very good advanced demand signal coming from those Kickstarter campaigns. So Dr. Dubey talked about wearables. One of our investments that I made was this wearable health tracker, Basis Sciences, and we looked at their order book even just from before shipping the product. We looked at their order book and got a really good sense for what their demand gen could look like once they actually did launch the product. So that's one alternative source of funding which any hardware startup absolutely must use, because and people have been able to raise tens of millions of dollars, Pebble being the most recent example. And the second one that's starting to emerge is AngelList. How many people here have know AngelList or are active on AngelList? So, in the Valley, I would, advise people if you have, Jonathan would not like this, so invest only very little on angel list. It's still a very, very risky, thing, right? I mean, they will tell you, you can lose your money investing there, but the idea is that a group of people come together and invest. They are the first round of capital into a company, right? And usually investing in a convertible note that then converts into equity when they go and raise money. And it's about $150 million raised on Angel last year, but significant growth. It grew 50% from the year before, and that has also become another alternative source of capital. And there's always been high net worth individuals. So you made money in Facebook or Google or wherever, and then you start investing those proceeds, right? So social capital being one such entity that came out of Facebook execs, etc. So high net worth individuals and angels have always existed, but this is a new phenomena of people who don't necessarily have that Facebook kind of money, but are still pooling their monies together to come and invest in a startup, in their first startup financing.
Jonathan, do you have a sort of addition to that in terms of, are those, is investing directly or is crowdsourcing a type of thing that you recommend?
I think it's we always look at it from the diversified standpoint. So it could be a part of your portfolio. Some things to think about when you want to consider that investment is, the liquidity of it. Where are your other investments? What's your job? Like, what's your human capital? Are you in a stable industry? Are you in a risky industry, right? If you're already in a risky industry, you're really counting on your stock to go public, you might be taking less compensation. Probably shouldn't be playing around on angel lists and things, but if you've already gone through a successful offering and you've got extra money, and everyone's capable of making their own decisions and living with the benefits and potential regrets. So, I think it's going to matter situation by situation.
Right. Dr. Dubey, I have a question for you. It's a remix of several questions that have come in. One is, with age, the cost of care is super high. That's one trend line which is sort of evident. The other is, there's a focus on health, but there's an alternative focus on wellness, which you're also interested in. Do you see businesses coming up there? And there's been a bunch of questions around how nutrition and whole life care is going to be a sort of a category that people will be investing in. Is that something that you've seen?
Yes, absolutely. So there is that wellness industry, and then there's a healthcare industry. And for the longest time, they haven't talked to each other. It's almost like a divorce that happened so many years ago. But the fitness industry or the wellness industry is innovating in silo. And that's their demise factor in there. So all the companies that are working in silo, just kind of reinventing wellness, the ROI hasn't yet been proven. VOI is there. It sounds nice and touchy and feely, and most of the organizations and corporations are investing in their corporate challenges or dietary changes on site and all of these good things that make people feel special. We are on Google campus, look around, free food is already here, and so are many other things, massage therapy, chiropractor, you name it, it's here. But does that add to an ROI? That's my job to figure it out. And that's where the wellness industry needs to talk to the healthcare industry, because that's where you can actually truly show your impact on patient outcome. So there are a few companies that are coming in nutrition space, there are a few companies that are coming in health behavior change or patient engagement stage, and then they are coming in the space of developing habits to walk or get your steps and other things, and gamification of it and socialization of it. All of this can only be fluff if it's not connected to the patient outcome. And that's essentially what it is. So I gave an example of telehealth, for example. It is a consumer-initiated query, but it actually takes to an actionable patient outcome intervention. So if somebody has a question about, my kid has fallen and he has a head injury, he's having nosebleed, what do I do? Do I go to the ER? Do I go to urgent care? Or do I watch him for a few hours and a nurse will call me back, and if he's better, I will avoid the visit? What it means to the patient or the parent is the telehealth provides them a comfort of an action that they need to take or can take. For me as a corporation or a corporate health leader, it gives me a spend trend that I can move the cost spend in the right direction. I am giving the right solution to my covered population, so they will avoid an ER visit. That's very, very expensive. Anybody has been to the ER? Okay, how much? Thousands of bills that you actually were followed up with. And some of those your insurance company covered, but some of those you had to pay out of pocket. And then second is urgent care visits. So if this kid is being taken care of by a simple phone call by the nurse, you have saved your ER and urgent care visit. Not just the company or the employer, but the employee too. So these are few solutions in which the consumer market can now start talking to the healthcare market. Another example is Livongo. I did cover a little, touched up upon it. Livongo is another patient monitoring device, which is sitting with the patient, the consumer, you and me. And that leads to some kind of a data that's generated, and there is a robo, by the way. So there is a lot of machine learning and AI, the buzzword, that is being used to generate custom solution or answers for the patient who's sitting in their house. Or there is a trigger that generates a human involvement or health coach involvement, or a trigger can generate a physician involvement. So my suggestion is to start looking at companies that have that don't sit in silo, and they are smart, that they connect the wellness to the healthcare industry, and then track the outcome. It is very important to show your numbers and the ROI.
All right. One final question for everyone in the panel. Everyone has to answer. The question is, when will robots take over the planet?
Not in the next 3 years.
So my question is, who in this audience is willing to have a robot operate on them? Okay? Who in this audience is willing to have a robot meet with them for their healthcare needs? And listen to their pain points. Okay? And who in this audience is willing to have the robot make the diagnosis and give you the treatment? So minority. So this is a human industry, and there are many variables, and it is the adoption is very, very slow. In surgical, yes, robots are making the outcome more predictable, but in human interaction, it is hard to replace your physician. That's all.
I think in 3 years, this panel will be robots.
No, there need to be robots.
Moderator would still need to be a human though.
Yeah, I have nothing clever to say on this. So I think there will definitely be jobs. I mean, we are, in fact, we are about to invest in a cognitive computing company, and they are like fully automating some of the clerical aspects in fact in healthcare, right? So claims underwriting, you really don't need somebody to be looking at every claim and deciding pass or fail. A machine can do that really well. A very smart machine. Same thing. They're doing that with help desk interaction. 90% of what you call a help desk fork, a machine can do that very, very well. So I think anywhere from 20 to 30% of jobs can be fully automated and but done by a robot. But fully automated, I don't know.
Yeah, I saw a recent article that said that machines can do everything that we've learned up to middle school. And the benefit of that was that we get to focus on higher learning and more creative thinking and doing things differently. Specifically on this, on the financial services industry, I think, like we have, tax professionals out there still. People are going to seek expertise, similar in the medical field, for certain areas. But there's going to probably be a wider and wider range, and I think you're going to see robos move up. Right, they're kind of on the very basic stuff right now. We'll give you a diversified portfolio, which you could actually go out and buy tons of single funds that give you all the things that a robo's giving you, but you're going to feel a little better because you went and did it through a computer. But they're going to start moving up. And you're going to see, and there's already a couple companies that are getting into advice and trying to deliver advice, because that's where the difference is between what the robos are offering now and what the financial professionals are really doing, right? The financial professionals are taking their years of experience, looking at all of the variables that you're giving them, and then they're helping you to figure out what your future looks like. Whereas most of the robos right now they're asking you some questions about the risk that you're willing to take and what you want to do in the future, and then they're building a portfolio for you. But they're not going to say, oh, you really should use this type of tax strategy. We should acquire this insurance to protect your business and your family in the case of their, of a debt. But those things will happen with time, right? They're going to definitely move up the intellectual spectrum, and it's going to force the practitioner to get more specialized and more of a niche.
This is definitely not my area of expertise, robotics, but from what I understand, the biggest concern is singularity, right? When the robots become smarter than us, and as it is at IMA, I had a hard time when most people got better grades than me. If robots are going to do everything better than us, that gets even more challenging, right? But I don't know, I think robotics in general is going to be an enabler rather than a displacer, but I guess we'll see.
Great, thanks. So this is a networking event. There's a lot of questions that you have which are best answered one-on-one. So if you haven't had your questions answered, this is a networking event. Go buttonhole the panelists and go ask them these questions yourself. I really enjoyed this Masala panel. I hope you've enjoyed this as well. I've learned a lot. Thank you very much to the panel for taking your time out and helping us see into the future. Thank you.
Thanks a lot to Gaurav for putting this together.
Could we request the panelists to stay on stage? And thank you, first of all. That was an excellent panel. I'm pretty sure. A big round of applause again. I'm pretty sure this was one of the most engaged panels that we've seen with diverse views across healthcare, fintech, marketing. Thank you, Gaurav, for having moderated this great discussion. Of course, I mean, as with anything in the future, I think we had both balanced views. We really did. We had some strong opinions come out, we had some balanced opinions come out. Things are going to be faster, slower, things are going to be evolutionary versus revolutionary, things are going to be regulatory aspects, non-regulatory aspects are all going to play a big part into what we're going to see in the next 3 years. So just to round it off, you guys are in Google, so you should be careful of AlphaGo and DeepMind going forward. So it's not just the robots, it's actually, I kind of agree with you over here that it would be a smart robot that we should be more scared of. But that being said, I'd like to invite folks.
The folks who are giving out the plaques to our panelists, could you please step forward? Thank you, Hazura Singh and Mr. Jaspreet. Yeah, thank you guys so much. And if we could maybe start with Mr. Ram Kapoor. I think that's you. Thank you.
We need pictures. So just stand like you're getting the Oscar.
And then the plaque from Mr. Jonathan next. Miss Archana? I think that's the one.
And with the banner.
There's a lot of pressure, guys. I know some of the panelists have already received their plaques earlier, is that right? Am I just confused? No, I know there's one left. Oh, I'm sorry. Yeah, okay. We'll go for Mr. Gaurav next, then Mr. Kapoor next. Okay. And who was the platform standing here? No, I think that's the one for Gaurav. We're really sorry about this. No, the plaque is around, we just don't know who has it. All right, so that's the most important one, I suppose. Thank you, Aniket. Thank you so much.
Here's how I want the picture taken.
Just so you know. You're up next. So yeah. Oh, okay. And then, all right, okay, another Rastoni. I'm very sorry about this. And finally, for Gaurav, that was, you moderated that panel so beautifully. Thank you, Gaurav. We also just want to do a quick vote of thanks. This is a really fun session. First up, thanks so much to our panelists. That was a really, really great discussion. Please. And thank you for spending your Saturdays with us answering all of our questions, because we obviously got a lot out of it. Hopefully you did to some extent, but thank you so much for passing along all that knowledge. Thank you to everyone who showed up today, especially to the volunteers. Could I please have you stand up so we can thank you again? All of the volunteers, thank you so much for your time and your effort. Also thank you to, and I don't think these guys are in the room, but the staff at Google that helped us out with a lot of the setup, etc. So big thank you to all of them. Maybe Amit, you can convey that for us. And then also big thanks to Ashima. Like I said at the beginning, Ashima is the connector for all of this stuff. So we're really grateful we get together, and she's responsible for making it happen every time. Thank you so much. We also had some, I also want to thank our sponsor, the IGN Network. Again, I don't know if there are any representatives here. Oh, hi there. Thank you for our sponsors, because we get to use this facility for free as a consequence, so, and that's a really big deal to us. Thank you so much for the sponsorship. And then I am supposed to do this. I do want to let you guys know, for I Am Bangalore folks, Anusmaran is coming up on the 14th of May. It's going to happen in Sunnyvale at a restaurant called Turmeric. So for those of you who are not aware of it or have not enrolled yet, you want to reach out, could you please stand up to Sandhya Krishnamurthy and to Simonal as well, if there's anybody else. So while you guys are out for lunch, if you have any questions about Anusmaran, please walk up to these folks. They're trying to make sure they spread the word. So I want to make sure you guys know that. And then I also know that we have some gifts for some of the newest graduate pool, members. So do we have Shishir Saraya in the room today? This is not a bad thing, so you don't want to be scared to come up. All right. Sachin Petkar. Is Sachin Petkar in the room? All right. He's one of our newest graduates, so we're just giving him a small gift. I asked Ashima the question that I think is top of mind for all of you. Why does he get the gift when no one else does? We can talk that with Ashima later.
It's going to be.
And then this is one of the complex algorithms that IAMS came up with. But
Thank you very much. Please pass the word.
do we have Anushri in the room right now? Anushri Jain from IIM Lucknow? We don't. Okay. Okay. 2014 graduates. Are there any others in the room? And we want the truth, not lies, like we see in that corner. Okay, 2013 graduates, anyone in the room? All right, okay, how many of you are there?
Whoever comes up first
Gets the freebie.
You have to run.
Okay, someone's clearly leading the pack.
Go, go, go.
And that's it. And should we maybe just stop there then?
Yes.
Because it seems like we have enough shirts.
You guys are too late.
Oh.
So the way it works is each year will be called out and whoever comes first. All right, keep going.
All right, and that's basically it from us for today. Lunch is...
Oh, keep calling.
What? You still have patience?
93.
2012, let's go.
2012.
And you want to make a run for it before someone else comes in.
Go, 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 go.
Oh, that's very egalitarian. They just walked up together.
All right.
Okay, now we're done. 2011.
93 then.
2011.
Okay, 2010 is up next. Any graduates from 2010? Wow, he's alone. 2009.
The last one, 2009.
All right, we have exactly one person left.
We'll get there. We'll eventually get there.
All right, I'm sure your stomachs are rumbling right now, so everyone's probably very hungry. Lunch is being served outside. You can sit outside and enjoy it, or come in here and enjoy it. And there are drinks, both soft and hard, right here. Ashima wants me to specifically call out that we are not responsible for your actions once you've partaken of those drinks. So please remember that this is the caveat. All right, guys. Okay, and the volunteers, could you please come up for a photo as a group, please? And everyone else can carry on. Thank you.
We also get the panel up here so that the volunteers would like to get a photograph with you. Thank you.